Hello, future millionaires, and welcome back to the Get Rich Slow podcast. I'm Adrian Schermer here with my co-host, Rob Delavan.
Good morning, everybody.
Good morning, bud. Today, I want to chew into a subject near and dear to my heart. We talk about purchasing property a lot here, and we talk about the gain in equity and how that is value. But let's talk today a little bit about how you can put that to work and how quickly you can put that to work, because it is called the Get Rich Slow podcast, but I feel like this timeline is faster than a lot of people realize. So
Right.
Let's chew into that. And my concept here is going to be how long would it take you to use the equity in your home to buy a second home? And when I say second home, I mean that as a term. Second home is a term that's used in the industry. We have primary, second home, and investment properties. So second homes are kind of unique. They often have great interest rates that are very close to or equal to first loan rates. And their core concept was exactly like it sounds. It's for someone's beach house. It's for someone's vacation home. This is a home that you don't live in primarily. It's the second, but it's a house that you utilize yourself typically. And that's exactly what you can do if you buy a vacation home. And we're going to chew more into the economics of having a property that in a rentable space where you can do more of a short-term rental thing. That's a whole subject that we're going to take an episode to spread all the way out. But this is just about the economics of getting access to that kind of equity, and what you can expect from equity gain in your house.
Right. And the beauty of this is it really is the core of the concept of the Get Rich Slow podcast, right?
Yeah.
Yes, it's quicker than you think. I mean, I'm telling you, like 5 years goes by in no time. But the cool thing is Adrian and I were just playing with numbers here, and it's kind of a 5-year plan, and you're probably doing it maybe a little quicker than that. And you're rapidly going from minimal down payment 5% and out to, okay, you're at 80%, and addressing those issues with better loan rates, refining, all these different options, big picture, but also you're building wealth here, and you're doing it through leverage and frankly discipline of making that monthly payment and building equity every single month versus renting and doing exactly that for building wealth slowly for someone else.
Yeah.
So do it for yourself.
Do it for yourself.
Damn it. Do it for yourself.
Absolutely.
Don't pay rent.
Absolutely.
So let's dig into, well, actually first, this second home mortgage. It generally requires 10% down versus the 5% down, right? And that's a big hurdle for most people who want to buy the second house. Yes. Now, you can always buy the second house, move into it, and do it as a primary if you've owned the first house for a year or longer, and you can do it. But there's this one kind of get out of jail free card with 10% down. You can buy a second house and you don't have to move, because we do get that. Like, I got to save up a bunch of money at the same for a down payment, but I like my house that I live in. I've done it up how I want it, good schools, good floor, whatever it is. People love their homes, right?
Yeah.
So the question becomes is, how do you build wealth without moving? Well, you get one get out of jail free card, buy a second house with 10% down, which is better than 25%, which is kind of the traditional number for, buying a home, an investment home that you're not going to move into. So
unless
we're going to run our numbers.
There's some pretty tough terms for those loans when you get down to like even 15% down. There are options out there, but they can be pretty expensive because they're going to be at a higher rate. They're higher risk, right? If you have a life event that causes you to not be able to pay your 3 mortgages, what's the one you're going to pay? The one you're living in. So
exactly,
on the craps table that is the statistics they read into in the background here, trying to figure out, interest rates are based on calculation of risk, basically, so a bunch of big math goes on. They figure out what are the average default rates and how much money do we need to make to be profitable and still, cover all the houses that we're lending money for. So here's a way to access that. And when we have that question, how do you get that pile of money aside for a down payment? How do you get 10% down on a $500,000 house? That's $50,000. That's a very difficult amount of money to put aside. For most people. So how do we get that after we've put a down payment into our own primary residence. And so I'm going to be running all these numbers at $500,000 because it's a nice round number, but this all scales. So it's going to be a 1-to-1. If you bought a $300,000 house, this same concept applies. It's just scaled down. And then the theory here is that, as we'll see at the 3 and the 5 year mark, there's a couple different ways that you could access equity and buy a vacation home that is of equal value to the property that you bought now at that present time. So including appreciation.
Right. So let's just go through the assumptions really quick as far as the numbers that we're going to use. And this is for our national audience, right? All three of you. This is the Portland metro area market, and this is pretty typical of the Portland metro area, Portland, Oregon metro area market. So let's assume $500,000 first house, and let's assume $500,000 second home. And let's also assume that the down payment on your first house was $25,000, which was 5%. Let's also make the assumption that you have a kick-ass real estate broker that works very closely with a lender who is going to, with that 5% down, you're going to have mortgage insurance. For the purpose of this, let's assume that that realtor is able to negotiate some down payment coverage, not down payment, but closing costs facility. To cover buying out of that mortgage insurance, which is usually the equivalent of a few years at a couple $100 a month. So $3,000 to $6,000, right, in closing cost coverage. Then let's assume that the second home is going to be that $50,000, the 10%, and also $500,000 purchase. And let's assume that interest rates are at, well, currently they're at what, about 3.25%? That's where we
3.25 is, pretty average right now. I'm going to throw it at a 3.5% rate. I always have to disclose this stuff, especially being industry. Interest rates, they're influenced by a lot of different things. Not the least of which is, your down payment, your credit score. You're going to have to run this at your own numbers. I think 3.5 is fairly conservative for right now. These numbers will shift though over time. But the way that you chip into the equity in your home shouldn't change hyper drastically. We can scale these numbers for anything. This is kind of just for some rough work here. So I'm starting with a 3.5%, which I've gotten plenty of people well below this in the past few months anyway. And that's at a $500,000 purchase price. That means your loan is going to start at 95% of the home's value, right? So, and at that echelon, you can't do anything. When you first buy that house, I know you've got equity there, but there's not really a product that I've seen out there where, I'm going to use what I'm seeing as industry averages. Most home equity lines or cash out refinances are going to cap at 90% of the home's value, maybe 80%, depending on how you're using the property. So for now, we're going to use nice conservative numbers and the more typical programs that you're very likely to find all over the country in any bank that you might walk into or talking to a loan officer. So and then the other assumption I'm going to make is a 4% per year appreciation rate, which is pretty much about what the average has been over the past few decades. We can make an aside and talk about 2009. I really think that that's kind of that's a whole conversation to unpack. And I know we've touched on it before. But the key thing I tell people is, there was a lot of fraud at that time. There's some great movies about that. The Big Short is an awesome, entertaining movie that actually tells that story very surprisingly accurately and well. And not to say that fraud can't happen again, but there are a lot of checks and balances that were introduced to prevent that. So if we do see another market crash where values fall, it's going to have to be something weirder. I mean, we just lived through a pandemic, or we're still living through it, and yet values have continued to spike. So it's supply and demand. They're still making people, they're still making houses. They're not printing land. The odds are that on a grand average, we're going to see values continue to rise. And as Rob and I have touched on, I mean, would you say like metro area is probably higher than 4% on average? Yeah. The closer you get in towards city centers where, the popularity is growing.
Typically, but let's just be very conservative.
Country average, 4%.
Exactly.
So I'm going to throw some data up here. If you're on the video, you can see this, but let's get the numbers out there for the listeners. 475 is your balance at year 0, right? So you're making before you make your first payment. By the time you've made a dozen payments, that balance goes down by nearly $10,000. You do chip into it slower at the beginning than at the end, but it's still a pretty good hike there. The principal and interest payment on this, by the way, using this rate and using this initial balance is $2,132.96. So you're gonna have taxes and insurance on top of that. That's not your total payment. You're gonna have mortgage insurance potentially in there. Of usually, I would say in this range about a couple $100 a month, but that's gonna vary depending on your credit score and some other stuff.
Right.
But that kind of gives you a ballpark of what kind of money is being shelled out for this. And then again, this all scales. You can press it down for a $300,000 loan about the same, but we're gonna use this as our baseline. So 475 goes down to 466 and change. And then year 2, you're getting down to 457. And then year 2 to 3, we're getting closer to that 10,000 a year. So you can see this growing. The balance goes down more and more because more of your payment is going towards principal than interest. And by the end of year 3, and these are the numbers that are important to me more than anything, we're at 447,500 for a balance, but the property has gained value. Now it's worth, in theory, $562,500. And the important thing about these two numbers, and the reason that year 3 is so important to me, is that now your balance is less than 80% of the home's value.
Right.
You can get a home equity line up to 90% of your home's value. So you can get a home equity loan that is 10% of that new value, that 562. You could, in theory, get a $56,000 home equity line, or it'd be a little more than that actually if we run these numbers. But let's round off for simplicity. And then even if that home that you wanted was $500,000 when you bought this house, and now it's worth 560, that's okay. You're going to take 10% of your house. Or if you buy a $500,000 rental property, you're going to have a bit of overspill there to maybe take care of some maintenance or maybe buy some furniture if you're going to do short-term rental type of stuff.
Right.
So there it is. Right there is access to about $56,000 that you can pull equity out of the house. Your mortgage payment's going to stay the same on the primary. You're going to have this new small payment here. So you got to be able to afford all 3 of these payments. Don't get me wrong. This has got to be, within the affordability index for you. This avatar is a person who's making, definitely getting into at least the low 6 figures to do this. But remember, this is also scale. So what I'm talking about is that at 3 years, in theory, this person's buying a vacation home that's worth $500,000 and now owns over $1 million worth of real estate within a 3-year span there, starting with only $25,000 as their down.
Now, let me jump in and let's just make sure that we know we're making this assumption that you could at least rent the house out, the second home, the vacation home or investment home, as we call it, with that 10% down, the 56K or so that you got from that equity line. You're going to be able to cover the new payment and the equity line based on the rent that new home would bring in.
Yeah.
And that's not weird. A $500,000 home today in the Portland metro area is typically going to get you probably not a brand new home. It might, Adrian, that's a good case study, like actually your home. But I mean, I have a home listed right now. Audience, don't worry about it because this will come out a few weeks later, but, and it'll be long gone, of course. But we have a home listed right now, single level, 1,700 square feet, 4-bedroom, 2 baths, that would rent for about $2,400-$2,500 a month all day long. Nice big lot, older home, but it's been updated and in great shape. It would be a perfect short-term rental, but also a perfect long-term rental. It would cover roughly what we're looking at on a short-term rental basis here. It would definitely cover if you were doing short-term rentals, which earn roughly double gross what a long-term rent rate would be. So 2,500 to 2,700, something like that, that this would rent for pretty easily, on a 1-year lease. It's going to be pushing 5,000 or so a month on a short-term rental. Now, short-term rental, Airbnb, those sorts of things have a lot more maintenance and moving parts and management expenses and so on. So we'll dig into that in the future on another episode. But
the lot of pros and cons to unpack there.
This is doable in that you could buy that second home and cover your expenses, which is the goal here.
Yep. Yeah, absolutely. And that second loan, there's a range of rates out there. It would be tough for me to kind of pin down. Most of those are usually interest only for the first 10 years. They're amortized over 20 years. So they're a funkier type of loan. You're going to have to chew into that a little bit more to figure out where you want to be at. They can be more like 5 to 7%. If you were at say 6%, you borrowed that 56,000, that's going to be another $400 a month out of your pocket that you're borrowing as a down payment now, effectively for this second home. And you got to make the mortgage payment on the second home. But that second home, in theory, whether it's short-term rental we're talking about or long-term rental, should at least cover its cost of existing. And then you're really starting at that point, you're opening a business that rents this property. You're a business owner when you own, especially short-term rental. You're going to be putting that into your tax returns. You're going to have profits that you're going to have to declare. This is something you want to really run the math out on. But what we're showing here is that in 3 years after owning a house, you can access 10% of the equity of that home, in theory, using industry averages. And then if we take it another couple of years, if you don't want to do that, you don't want to add the $400 payment, right? The balance goes from that 447.5 down to just under 427. And the theoretical value at a 4% gain per year goes up to 608. And now we're a lot closer to the loan being about 70% of the home's value, which means you could do a refinance of that whole loan itself back out to 30 years. You could have a new loan that's at 80% of the home's value, a cash out loan. So if you got 608 for a value, that means your new loan is going to be about 486, which isn't that much more than you borrowed in the first place. So if rates are good when you make that move, or as good at least of the one that you had before, you could refi at that 5-year mark and in theory get a payment that's pretty close. Probably lower actually too, because as we mentioned, even at the 3-year mark, you're going to get to that 80% loan to value. So at that 3-year mark, you should also be able to, if you had monthly mortgage insurance of a couple $100, drop it off.
You can get rid of it. Exactly.
You drop off a couple $100 worth of mortgage insurance. You take on a $400 second loan payment. Where are you at? Net, I'm paying $200 more a month, but now I've got 50 grand to put down on that vacation home.
Right.
And then have a 10% down situation, which is also a lower payment here.
The key is what you're looking at is time is on your side. So at 3 years, it was probably like, barely break even. At 5 years, you're sitting pretty. Now, let's take it to the next level, right? So let's say every month from the get-go, instead of making that, $2132 monthly payment on your primary house, let's say you throw an extra $200 a month.
Oh, brilliant. I like that too, because that's that difference there between mortgage insurance savings. And so if you got used to that, just paying $200 more, you could get the second and they would null each other out. You'd have the same amount of pocket. But yeah, go ahead. So
throw those numbers in there and, the year 0, you're at 475, but year 1, after 1 year of doing that, so you're basically out, what, $2,400? You're looking at 46,000. Oh, well, let's see. Let me run the numbers.
Yeah, I got to scale this out here.
At the end of year 1, end of year 2, I'm sorry, you're at 452,000 that you owe instead of 457. Year 3, you're at 440. And year 4, you're at 427. Year 5, you're at 414. And your cost was, if we did our math right there, is what, like 12 grand?
12 grand. Yeah.
So you spent $12,000 and you're really in a much better spot. The concept is usually you have a significant other that also works. You're in a spot where usually when you're buying your first home, your income is increasing. You don't want to necessarily purchase basically be at a monthly payment that every single dollar that you possibly have is squeaking out to get into this loan. So make a little extra, monthly payment. Look at it as a savings account, and you'll be able to unpack that on the back end. You're going to have huge, after 5 years, jump in here, Adrian, and tell, after 5 years, what was your loan to value?
So after 5 years, it's 70.18. If you don't make that extra payment, it's 68.07 if you do. And one of the key things to me too was that by year 3, you actually were this loan to value is quite a bit lower. So somewhere in the middle here. I mean, this could be even just 2.5 years. If you make that extra $200 payment in this scenario,
right,
somewhere right about the 2.5 year mark, you're going to hit 80% loan to value. You're going to drop your mortgage insurance from the monthly payment, and you're going to have the ability to go back to a bank and say, hey, I want a home equity line of credit, or I want a home equity loan. Let me get the figures for that and make a decision if you want to borrow out that extra 50 grand or so, and then turn that money directly right away into the other property. You definitely don't want to let it sit in your account. And there's other things you can do with this, right? We're going to talk about, you could use it to start a business. You could, the second home is just an example I'm throwing on the table because this is a way I know to build wealth. And I know that if you buy that second home, that's $500,000. Now you're at $1 million of owned real estate, which at a 4% appreciation is going to get you an equity gain of about $40,000 a year,
right?
Which is more than I've made in some years of my life.
It's going to
stretch.
Yes, right. So, and you're doing it. While
did this take a lot of capital? Do you have to make good money in order to do this? This is not simple. It's not for everybody. I'm not saying that it's scalable though. So, in an area where $300,000, like in the nation where $300,000 is more of an average, and there are still plenty of homes in what would be considered vacation areas that you can buy in that range as well. It's going to scale the income that you get off of it, but it's accessible to someone who makes a lot less money than the hypothetical I'm building out here.
On that note, remember, we've done podcast on, dual incomes working at McDonald's, right?
Yeah.
You work for a couple of years at McDonald's, you're managing the place, you're going to make $60,000, $70,000 a year.
Yeah.
You're working your butt off, doing all sorts of different things. But if you're into it, do it. Dual incomes, $60,000, $70,000 a year, there's 120 grand. 5 years out, you're here. You're
5 years out, you own
home.
$1 million. You in the bank, don't get me wrong, own $1 million plus worth of real estate.
And 25 years later, it's all paid off, and you're in a good spot. And that's the difference between retiring and eating cat food on Social Security. Good luck, or having some assets that you're out doing things and minimal overhead because you own your house outright, and probably a rental or two or three, that you're also doing the same thing. So,
and once you've got this second home and you're reporting income, especially when you're reporting it on your taxes, once you've done that for a couple of years, that is now part of your adjusted gross income. You own a rental business and you do whatever your current job is. And this is where the multiplicative effect comes in. You can use that to buy more properties that you can invest because you've got access to these funds now. Your cash flow is different. Or you can just let that be, like you're saying, you can just let the balance keep falling, and that alone is enough to really accelerate where your life is going to end up.
Right. So let's leave it at that. This is just fascinating. We will, for future episodes, we'll talk about more of the short-term rental Airbnb model and how it would coming back to, and pulling into, what that would look like in this scenario, as well as, there's a number of other different directions we can go with it, but this stuff is doable, and that's the beauty of it. So I love it.
Absolutely. You got it, man. Thanks a lot for your time, everybody. We'll catch you next time on the Get Rich Slow podcast.
All right. Thanks, Adrian. Take care.
You too.